Hi everyone, it's your daily 10-minute business and finance news wrap for this Monday, the 24th of October 2022. The Australian share market rose this week up 1.5%, 6,779 to start off the week. That's this Monday. That's ahead of this week's official inflation data coming out on Wednesday and ahead of tomorrow's federal budget. For more, I spoke earlier with George Boubouras from K2 Asset Management.
A number of factors, but US markets was a good signal, but on Friday night, leading to the expectation, yet to be verified, that possibly the US can increase rates at a decreasing pace, and that will be enough for a turnaround story in late 2023, 2024, and therefore markets, given valuations are compelling, they're not expensive, are just having a bit of a rally on that narrative.
Is there really that view that we may start to see global central banks start to ease that pace of rate rises? Like you mentioned, that there's that talk of the US doing it, but it's also something the RBA has already started. It lifted interest rates by 25 basis points instead of 50 in the previous meeting. Could that also influence investor sentiment?
Oh, without a doubt. And I think the RBA was one of the early reserve central banks around the world that surprised on that increase that was 25 instead of 50. It doesn't mean the RBA is going to not continue raising rates. It's just that the big ones are behind them, and they're going to keep them higher at these levels for longer. Remember, the Reserve Bank of Australia, like all central banks, are trying to, what economists call, create demand destruction, slow down the economy. That equals pain at the household level, and that's what their role is at the moment. It's not very pleasant to deliver, and that's the only way they're going to be addressing the inflation issues that they have at the moment.
So we'll get the inflation numbers on Wednesday. Today, in terms of economic data, we also saw China GDP 3.9% for the quarter year on year. That's stronger than expected, although still below that 5.5% that the government wants to target. What do you make of those numbers? Because it is more than we thought. Still, the economy there is slowing. What does it mean for Australia?
Yeah, so China's number 2 economy in the world. It's been slowing very aggressively since the first half of calendar 2021. At the same time that Beijing started putting much more robust regulation over their markets. So they've got a number of different things going on, but a slowing economy. They have a housing problem that's one of the largest ever seen in the world. And post the party Congress, they're going to have a tighter grip on their recent 18-month move towards more control across their economy, less trade, and a bit more of a geopolitical risk at the margin. So a slowing economy for China means a slowing global economy, means all things being equal, lower demand for iron and coking coal. But they are going through this very aggressive adjustment and change of their economy the past 18 months. And the recent events of the past week reaffirm that that's the pathway they're going to choose. So you're going to have the US-led economic drivers versus the China-led economic drivers for the foreseeable future.
Back to the markets today, which sectors exactly led the gains and why?
Yeah, a lot of sectors, but materials, which are the BHPs and Rios, because they've been oversold on the expectation of further weakness for longer next year. So it's a bit of a relief rally from that oversold position. Again, BHP, Rio, they've got core iron ore bulk commodities. They've got core metals that are required in the energy transition that every economy is underway for not for here and now, but in the many decades. But they're very strong cash flow businesses. They're just undervalued, and they're the main drivers of the day.
Okay, another key economic event tomorrow, the federal budget. Does the market really care? Does it really affect shares? Is there anything potentially here that will impact it?
Yeah, the market does care, as the events, unfortunately, in the UK suggest. So the first budget here for this government really needs to address the basics. So there's a political aspect to it. But it can't be too expansionary because the Reserve Bank is making it very, very clear that they want to slow the economy, deliver demand destruction, which equals pain at the household level, to address inflation. And if they come out with a budget to be stimulatory, that is at odds with the RBA. No one's expecting that, but it is important that they hit it, the ground running with a conservative budget that deals with what they promise politically. That's what politicians do. It's their issue. Whereas fund managers expect nothing too drastic and nothing that's going to be an expansionary budget. And the final point, the last 6 months with commodity prices has really delivered a lot of tax receipts to Canberra, and that is required, obviously, for some of their promises they made during the election.
On that interest rate theme, the Australian dollar, it's been quite volatile over the past couple of weeks, especially threatening to go below 60 US cents at one point, then bouncing back. Obviously, it follows these interest rate expectations. Where do you see it going and why?
Yeah, we see lower Aussie dollar. Just as a backdrop, the US dollar strength year to date against the yuan, the yen, the euro and the sterling have been absolutely unforgiving and has led to a lot of pain and volatility globally. The Aussie dollar, being a commodity exporter like Canada, Indonesia, South Africa, Norway, has had a bit of a support there. We should normally be around a 52 cent if it wasn't for that terms of trade boost from commodities. So a lower Aussie would make sense in line with a lot of other economies that have been going through that pain for most of the year.
Finally, bank reporting season's upon us. The shares of the big four banks have been up over the last 3 months despite some very weak share market moves. Macquarie, though, has greatly underperformed. What's going on in this space?
Yeah, so very quickly, Macquarie is not really similar to the big four banks, and the big four banks, there are differences. NAB's the business bank, CBA's the retail bank, ANZ lags mortgages, and Westpac somewhere in the middle. The best performers year to date is Westpac, NAB, CBA and ANZ in that order. And then, as you say, Macquarie. Macquarie has got good US dollar earnings. That's priced like a JP Morgan and Goldman Sachs. It is linked to global recoveries, global commodity cycles, global investment cycles. They have got a growing mortgage market very quickly, and that is building up from a low base. But basically, you can't outperform the other big four banks every year indefinitely, and that year to date has been an underperformer. When we're looking for a turnaround global economies, we'll see that Macquarie Bank will benefit sometime in next year and into 2024.
George Boubouras there from K2 Asset Management. This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.